You hear me, right?
Yes.
Okay.
Okay, fantastic. We are live on
You hear me,
YouTube,
right?
and I will start the
Yes.
recording.
Perfect. So, okay, everything is set. I think I can start.
Sure. Please go on, Sarah.
Okay, I can start this session. So welcome to everyone. Welcome to those looking at this event on YouTube, and thanks to all the panelists here today. We are the Euro-Mediterranean Economists Association, EMEA, and we are in Dubai for COP28, and actually this is one of a series of events that we are running during this time here in Dubai, and we are hosted in the Mediterranean Coalition Office, and it's like coalition of different institutions and think tanks working in the Mediterranean area. And today we are going to talk about ESG, and as you all know, it's like one of the key pillars for the transition and climate financing, to taking together in consideration environment, social and governance aspects. And we are going to analyze it through different perspectives today with a great panelist. And I would just like to say that we are very happy to have the possibility to discuss this, also because we went through a lot of different table discussion and events, and I mean, it's very clear here at COP that we need to mobilize finance as fast as possible. We don't have time to lose, and we have to do it properly, not excluding anyone, particularly taking into account the most vulnerable, and keeping always together the social, governance and environmental aspects. So I will not add anything because time is running, and so I leave the floor to Yeganeh, which is my colleague, actually connected from Slovenia today, and she will moderate the session. So thank you very much.
Thank you very much, Sarah, for this introduction. So let me start by thanking our distinguished speakers for accepting our invitation. It's a great honor to moderate this panel, which is very timely on ESG and how to drive sustainable growth and responsible investment. There has been a growing recognition among investors, consumers, and also policymakers about the impact of business activities and environment, about the impact of our investment on the environment and the society, and this has led to an increased demand for environmental, social, and governance, so ESG-focused investments, and that requires greater transparency in corporate reporting on ESG metrics. So I was reading an article in Financial Times that came out like 4th of December, a few days ago, and it showed that even though the European flows into ESG have held steady recently, but US investors have been pulling cash out of these funds. And I was wondering why this is happening. Are there some anti-ESG lobbying happening on the side? And because also the article was mentioning that 18 states have adopted some kind of anti-ESG legislation. Some of the laws has banned discrimination against companies that sell fossil fuels and guns. Others order state pension funds not to consider environmental and social factors while investing. So this is a bit surprising. And some argue that the problem is that ESG funds are often addressing too many factors at once, and they are not very interesting in the terms of profit making from an investor's point of view. Others find ESG reporting to be burdensome, and there has been some efforts by the governments and financial regulators to take some steps to standardize ESG reporting and disclosure requirement. And these moves aim to enhance transparency, comparability, and reliability of ESG information that allows investors to make informed decisions. So some of the examples can be International Sustainability Standards Board, ISSB, and among others. And I would like to know which of these numerous efforts have been that have been taken place are solid enough that can make ESG investment a reality, and somehow we can put it inside our regulations. So first of all, I would like to invite our first distinguished speaker, Nisaa Jetha. She's the founder and CEO, and among many other activities she's doing on the side, and she's she's a promoter of SDG investment and ESGs, and she is currently working in the impact for SDGs. And I would like to ask her about ESG integration and the negative screening approaches in this investment happening, and the management spaces and the role of impact investment to promote SDGs. Please, Nisaa, you have 10 minutes. We are very eager to hear your intervention.
Thank you so much, Yeganeh. I'm just trying to pull my slides. Should I pull them up, or are they going to be shared? But just while we do that, I think you'll share it, or shall I share it? And so I think that you push on several points. One is that you're definitely seeing institutional investors, perhaps more in Europe, looking at a want to report and or a kind of likelihood to look at ESG more on like a robust practice, because there is a narrative around, you know, longer sustainable growth for business practices, as well as within the investment space. To the global space, as you rightly mentioned, around ESG is really, really polarized, and the narrative is shifting. Which I will kind of comment on well, and kind of this focal point around greenwashing. And then to your point on the regulatory gymnastics around who is moving the needle and what should we be using on metrification. So the first slide is just kind of a set the stage around what environmental social considerations can do. And when we talk about investment management, I am not polarizing, but I'm putting that around, you know, investment management spaces. So vehicles that are looking to coalesce and hold portfolios. And then we are now seeing that ESG is also creating a paradigm shift. And I wanted to also showcase that there is a differentiation between ESG investing or negative screening, and that means what we won't invest in and or look for. And then that can also inform what our positive impact can be. And so to your point, I now, instead of using the word ESG, I often use the term thematic investing. So if I could just kindly go to the next slide, I would be grateful. And so what we decided to do at Impact for SDGs, by way of personal background, I actually worked as a policy analyst. I was working on a political lobbying campaign that helped democratize access for the release of a patent for antiretroviral drugs. I then worked in Canadian Parliament as a speechwriter, and then went to law school, where I was then working in-house in the private equity space, benchmarking portfolios against the Sustainable Development Goals, also undertaking a negative screen of our portfolios against E, S, and G. And what the metrics I found worked very nicely were in emerging markets, we were using something called the International Performance Standards. And we found that if we had almost a proprietary or thematic lens on what we would use across our assets. So if it was a pharmaceutical company, it would be nuanced. If it was an oncology company or an infrastructure company, we'd be using different metrics. We always did look at our environmental, social, social, and governance lens. And we use that to negative screen. There were certain environmental waste and sanitation things we would obviously not like to participate. On the S, we built out our social compliance and human rights regulatory framework. And then we went to the board and we said, we will not engage in a proper ESG practice if there is no governance. So we found that at the portfolio level, that a lot of people, when they use the word ESG integration, they could lie, because they could say, we are going to do all these mandates, but if we didn't have our binding legal structure in place, it was very much a marketing exercise. And when we did that, then we also bound our governance into saying, because of this, we will also then have forward projections around hiring more women on boards, engaging with the local community, making sure we have cultural awareness, and we benchmark those impact benchmarks to the Sustainable Development Goals. So when we look at impact for SDGs, we are cutting it across the impact investing ecosystem on your right, and then looking at strong governance, because we believe that we aren't really able to kind of metrify or get to those outcomes unless we have responsible and a binding governance metrics in that. And then just going through our next slide to kind of showcase around best practice and what this means and from theory and practice is this is the proprietary model. What we found is that because we work so interdisciplinary and also across sector and across countries, we then looked at the international environment. So often global governance does give an economic overview, and I'm very excited to hear from the other panelists on their economic outcomes, because there is, as you rightly mentioned, a kind of dissonance between metrification and what to use. So often when we have that global governance framework at things like the World Economic Forum and COP, we are able to be a little more nuanced. Then we partake in ESG on a negative screening in the private equity space on things we don't participate in around the environmental, social, and governance. And then we look at our impact that we're looking to create, and we don't want to impact wash. So we are very curated on what we look at. And then this rising aspect of climate compliance, which is coming out, which also leads into our regulatory compliance. We then see both of these informing and regulating, and we use responsible governance to tie it around, because we can say we're going to do this, but we don't have governance metrics in place. We are going to fall on our matrix. And then just moving forward to the next slide. What does this all mean very quickly? So ESG integration in the investment space, we are incorporating the relevant social, environmental, and governance factors in our decision-making. So if it came up with a very high risk profile, we would say this is a red flag and we wouldn't pursue it. Or we would then attach very much a significant capital into making sure that we had a strong ENS and governance profile. We found that this was an intangible way for our operations and policies to really show value. And to your point, if you invest in this compliance at the outset, your asset can actually outperform long-term and lead to sustainable business practice. So this was our negative screening approach. And then when we look at the role that this places around private equity, it was that we really are using this term SDG integration. So which part of the 17 goals do you feel across the metrics in your portfolio could you really align to? Oftentimes when I see all SDGs across all the verticals, I wonder how much nuance and thought came into it. And then when we go to the governance aspect, so we're seeing ESG around the negative screening around E, S, and G. The impact is what we could make in the portfolio as a positive score. And then the next slide, when we talk about governance, was just the geographical boundaries of our reporting. We need robust frameworks. We need something that is harmonized, that marries up across border to help mitigate the risk. Because if I'm reporting in Canada and someone is reporting in Nigeria and we're not speaking the same language, there is a very high risk of greenwashing. And this is kind of the argument that has also come out of the US around a lot of ESG has been used as a very interesting marketing tool, and people feel very fearful of this. So the language and the vernacular is changing to to kind of talk through thematic investing. And something we use at Impact for SDGs across all our portfolios is this notion on responsible governance. So it is crucial to our financial institutions to be transparent, to be ethical, and to kind of report at board at level, embedding all of the considerations around corporate governance, and that to be highly aligned in the business operations and the brand. Because if we don't have buy-in across there, then we're not going to get anywhere. And then just moving forward on how we came to the being was that I did a specific timeline. I said, okay, we went from the Millennium Development Goals in 2000 to the 15. We had a different mandate of 8 goals, very different vernacular, very different feedback from civil society. And then at the same time we adopted the SDGs, we did have the Paris Agreement. And right now, as we know, we are at the global stocktake. And then when we did have these macroeconomic trends, like the pandemic, the war in Ukraine, obviously a rise in energy security, a very big shift between the haves and the have-nots. So you also have a very interesting rise in conscious consumer culture and an expansion of impact verticals, and then a rise in regulatory compliance, which then fell into metrification, where I understand the genesis of our forum, where there was just so much to report. So either people metric wash, don't do it, or get very confused. And then right now we have, after the COPs and various global governance forums being on pause, we had the loss and damage, very interesting vernacular coming out around the global south, and a shift in how international cooperation is moving. And so all of these actually macro trends around the global governance angle really inform our policy at the top, that we need to also think about business and across pollination and where we align on regulatory compliance. And then just moving on to the next slide, is that what I found is I actually work across major international corporations, brands, the investment management space, and government. And I found everybody is speaking a very different language. And this is also a very interesting and actually hard to kind of marry up on what to report on. And so this is where Impact for SDGs truly would like to use the SDGs in a proprietary way through your portfolio, to not impact wash, to have proprietary reporting, and to create a system around what we call negative screening. What is your impact and how are you reporting it, with responsible governance at the bottom to put your money and your teeth where they are, and looking at an external economic overview through global governance and those information. And then just moving kind of slowly to our close, I appreciate everyone has a moment here, so that we did, as I mentioned, a negative or positive screen. When we look at emerging markets, we also really need to think, and I saw our KPMG panelists, on the integrity due diligence, right? So if there is a reputation issue, that is now coming into a lot of our ESG reporting on the social and the governance angle. So very specifically, I found in emerging markets, the international performance standards are very helpful. I found that when we negative screen, we can put them into an environmental social management program. And this is where our governance structure, we would then put an environmental social management binding legal structure. It's okay if your portfolio is a mess, as long as you have a plan and capital to say that you will do what you're going to do with governance. And then when we look at our positive scuff score, when we looked at brands, I found that the S has very specific considerations and the E has very different considerations. And then just moving on forward to our next slide, I just tried to put through like our pragmatic approach. So with the whole metrification, we can be specifically aligned on ESG screening, our negative flag. What is our strategic implementation plan? So you have a problem on your waste environmental. Are you going to implement new rubrics? How are you attaching capital? And how are you leading on best practice? Here actually could be a very fascinating impact story to take a portfolio from a negative puff score to implementing best practice. And I think this is where we can lead with binding legal commitments, implementation and monitoring, and making it proprietary. So this is how we view our ESG implementation strategy, to showcase that your portfolio wouldn't be greenwashing, that you have yourself held responsible through a responsible governance matrix, and that you're being very thoughtful about your approach. And just, I think we're going to our final slide, and I will stop my intervention after this, is that on the impact side, after doing ESG, is that we would put together a responsible investment thesis, an EDFI list, very similar to a negative screening, on saying what we would not invest in and or do, and then asking the right questions on investment around negative screening. What would your portfolio, brand, company, government overview like to achieve? What is the positive and negative externality you're not looking to make or looking to make? And how are you measuring progress? What metrics are you using to mitigate the risks? Are you aligning to international treaties and binding to showcase them, and then putting capital behind that? And so our final slide just kind of provides a very brief overview of this as well. And this is how we have found it to be very helpful in order to not greenwash, to really align to international global standards, and to be proprietary with our approach.
Okay. So thank you
so much.
Thank you very much, Nisaa. This is very interesting and inspiring, and the pragmatic approach you're proposing about, and thank you for sharing your own framework for ESG implementing strategy, and thanks also for highlighting the importance of having a strong governance. I think this is a key issue, and that we need, and also highlighting the importance of having a global governance to avoid impact washing and greenwashing. So I think it's very interesting, and let's because the time is running, and
thank you so much.
It was a pleasure to have you. So let us move to our next speaker, Professor Giovanni Ferri. You are a professor of economics at the LUMSA University, and I would like to hear your thoughts about the regulatory landscape and policy developments that we have on ESG implementation. Thank you very much.
Thank you very much, Yeganeh, and thanks very much to EMEA and the organizers for letting me participate into this very interesting webinar. I hope you can see my screen. Please confirm.
Yes, we can see yours.
Okay, that's my speech, which is of course limited by time, will hinge around three different topics, but they're very much related. The first question is, does the ESG approach mostly belong to the Western world? And here I come close to what Nisaa was saying before, that sometimes you may get lost in translation because ESG may mean different things in different places. The second issue is the regulatory versus optional approach across the Atlantic Ocean, where I will compare the EU versus the US. And the third is the reliability of ESG ratings that is clearly to some degree to be improved, to say the least. So let me start with this. I'll give you visuals that are easier to represent where we stand. Now, this is the G20 country scores for sustainable finance and ESG disclosure policies. And as you see, the deep red is unfortunately close to where the COP28 is located physically. And the red is the worst case, but the best case is the deep green, is Europe, mostly European Union. There is some green in Canada, and for the rest, we go down to yellow in the US and to orange, which is closer to red in Australia, India, South America, and certainly Russia and Turkey, as you see. Some countries are not rated because it's the G20 countries only. So this is telling you that mostly the issue of ESG is very well scored in Europe and in some of North America, and China may be approaching. So this is not for the entire world. Second issue, the regulatory versus optional approach across the Atlantic Ocean. As you see in the left panel here, the reductions in the greenhouse gas emissions, the targets and where we stand, the US is much lagging behind the European Union. And although by 2050, they both target to reach net zero, the EU is a little bit more credible than the US over here. This is the word. And also that depends on a long history. If you think about the Kyoto Protocol, if you look at the only country that never ratified the Kyoto Protocol on the reduction of CO2 and greenhouse gases emission is exactly the US. So this brings me to the other aspect which is related to taking actions credibly towards the green transition. In Europe, there has been a lot of progress in that respect in terms of using the regulatory approach. One of the key steps was the non-financial reporting directive back in 2014, and now European Union is moving to the corporate sustainability reporting directive, which is much more pervasive and deep than the non-financial reporting directive. But even before the non-financial reporting directive took effect, which was basically enacted in 2018, if you look at the extent of GRI reporting, the GRI, the Global Reporting Initiative, is the most widely used standards has been for a long time before the introduction of the SDGs, and it continues to be highly used today. As you see, the EU companies were more frequently doing GRI reporting, and when they did, the quality of their GRI reporting was also higher. And the other aspect that I would like to underline is that the ESG are clearly coming out in the European Union regulation. They come out in 3 of the 10 actions that were enlisted in the action plan on sustainable finance. Action number 4, investment advice to integrate ESG. Action number 6, credit ratings to integrate ESG, and action number 7, investors' duty to integrate ESG and increase disclosure. So the difference between the European Union and the US is that in the European Union the European Union is integrating the ESG into regulation. So considering also the fact that most of the European Union is based on civil law rather than common law, that makes a whole lot of a difference. And now, this is the situation in terms of ESG ratings across the world until recently. If you look at the best achievements are reached by the Nordic countries, of course, and we would expect that. But after that comes Europe. And look at Europe versus the US, you have a 23% gap between Europe and the US. So it is understandable that all the actions that were taken by the European Union have had some results, some achievements on the ground, or on the opposite, it is understandable that in the US, it is most of the companies may be less prone to be relying on ESG ratings, and they might wish to adopt something else, and also the state reactions in the US that was mentioned earlier. Now, but is the ESG panacea? No, not at all. I mean, if you look at some data which are from a few years ago, to tell you frankly, but they were published in 2021, by the European Commission in Director General for Financial Stability, Financial Services and Capital Markets Union, a study on sustainability-related ratings, data and research. And as you see, we have a problem with ESG because there is a strong bias, which is clear from the top panel, according to capitalization. Largely capitalized enterprises get higher ESG ratings no matter what. And also there is a large capitalization bias if we go down to analyzing different rating agencies, these different ESG providers. Rating agencies, number 3 is less exposed to this bias, but look at number 2 and number 1. And this is all coming from the project Aggregate Confusion that was run at the MIT Sloan School of Business by Bert Kohlbel and Rigo Bon, and it was recently published in a paper with the same title, Aggregate Confusion. And also there is lack of significant correlation, what they discovered across different ESG rating providers in terms of the classification of the entire ESG score, and particularly of the G component, which is very tricky, as Nisaa was saying earlier. So what we need to do and what is for the future, clearly we need, and this is particularly a very important task for Europe, we need to improve the reliability of the ESG ratings. How can that be done? There is a lot of action in Europe in terms of auditing marketing materials, sustainable environmental claims, carbon accounting, implementation of environmental labels, training employees, and monitoring marketing materials. And but if you wish, the most evident action has been the introduction of the green taxonomy. The EU taxonomy taxes sustainability and puts an end to greenwashing, somebody is claiming. And how the European Union is doing that? It is doing it by identifying 6 different drivers. One is climate change adaptation. One is the protection and restoration of biodiversity and ecosystems. One is the pollution prevention and control. 4th, the transition to a circular economy. 5th, the sustainable use and collection of water and marine resources. And 6th, but not least, climate change mitigation. Now, these are complemented by this, the DNSH principle, the do not significant harm principle, which is very important, and it cuts across the board. Now, the green taxonomy, unfortunately, although it is very important, it is not all, because we are lacking a social taxonomy even in Europe, and perhaps a governance taxonomy to improve the ESG reliability. And the other big question which I give to the floor and to the other speakers, if they want to tackle it, is will the ESG rating providers follow the EU approach? If we look at them, originally, the ESG providers, there were some from Europe, but now all the European, or almost all the ESG providers from Europe have been bought up by the US rating agencies. And so the US rating agencies are global rating agencies, certainly, but they are US based. So that, will they be able to take the EU approach of the, or will they still continue to have the US approach? In that case, I leave this as a big question mark for you and for the panel. Thank you, Yeganeh, and thank you all.
Thank you very much for this very nice overview. I mean, some sad things in it would be that ESG adoption is mostly like Western. What if we want to fight climate change and the global crisis that we have currently, we need to act collaboratively. I think that's one thing that is clear, and I think it's very important and key to make other countries to have them on board. And also, as you were mentioning, the problem of capitalization bias, and that big firms normally have a higher ESG factors. I think that's also a big issue, and that needs to be tackled. Thank you for highlighting it. And also you were saying that the real reliability of ESG ratings is a bit questionable. So I was wondering whether a standardized approach would help if we have it by some international institution. So let's come back to it like at the discussion part. But thank you very much for this very nice and global overview. It was very I think it set up the scene very clearly, and now we know more about the challenges we're facing. So with this beautiful overview, let's move on to our next distinguished speaker, Ms. Véronique Ormezzano. You are the founder and chairperson of VYGE Consulting. And I would like to hear more about your point of view about the advances happened in the ESG from a corporate perspective, so in corporate governance. Thank you so much for joining us. The screen and floor is yours for 10 minutes. Thank you.
Thank you very much, Yeganeh, and thank you to EMEA to have me in this very distinguished panel today at the COP28. I'm indeed now an independent expert on ESG policies and advising some boards on these topics. And so I will indeed focus on the inclusion of ESG factors in the corporate governance. First, I will go back to the policy framework. So I will not repeat what Giovanni said quite elegantly just a minute ago, but focus maybe on a little bit more granularity on the governance aspects and its evolutions at both international level and EU level. And then I will provide some facts on the current state of play of implementation of those frameworks, the progress that is being made, despite being sometimes criticized. You know, as always, the glass can be seen half full or half empty. And also conclude on the challenges that are still ahead of us, because clearly there's no room for complacency, and all of us need to accelerate our efforts. So first, on the policy framework, I would like to remind that actually governance has been at the core of the ESG policy since the very beginning of the journey, right? In the TCFD framework, governance is one of the 4 pillars on climate-related financial disclosure, together with strategy, risk management, and metrics and targets. So clearly, it was understood from the very beginning that nothing would happen without a strong governance framework. I think I would borrow the very nice words of Nisaa as the previous speaker, saying there is no ENS without a proper G, and I would totally agree with this. Then we have had also governance being part of other frameworks that were also voluntary frameworks. TCFD, of course, was a voluntary framework, such as GFANS, for example, which focuses on the financial sector, as you know, and also ISSB, which has the benefit of covering all sectors of the economy. All this includes governance in the framework, but more as you have to disclose if you include ESG in your governance. So it's because it's a disclosure framework and not a due diligence framework. It's only if you do it that you can, that you should, and you have to disclose it, but not, you have the option of course, of including or not ESG in your governance framework. Obviously, that makes a very important nuance. More importantly, and quite recently, I would like to cite the OECD. As you know, the OECD is the institution at international level which has been tasked by the G20 back at the time of the global financial crisis to be the reference as regards to corporate governance, and they have their principles of corporate governance that have been there for probably more than 15 years now. in their latest revision that took place in 2023, which was endorsed by the G20 in July 23, it has included the ESG in the principles of corporate governance. And I would really encourage anybody on the call to look at this new chapter in the principles of corporate governance, because they are very clear, and their principle is extremely simple and pragmatic. It is to say, the board must act in the best interest of the company. That's the fundamental principle of corporate governance. Due to that, incorporating ESG into the board actions and responsibilities is part of the best interest of the company, because it is very clear that no company can be blind on ESG matters going forward over the long term. So the board, as a normal responsibility, if you like, has to determine the strategy of the company. This means the board has to determine the ESG strategy. The board has to monitor implementation of the strategy by the executive management and by the firms, which means the board has to monitor the implementation of the ESG strategy, and in particular the commitments. Third, the board has the responsibility to validate the financial accounts, and therefore the board also has to validate the responsibility to validate the ESG extra financial reporting and metrics. And finally, not very importantly as well, the board has the responsibility to validate the management remuneration framework, which means it also has to include the ESG KPIs in the pay framework. So it's a very cohesive and holistic view of corporate governance, integration of ESG factors. And it's very much in line, if you like, with the EU principles that I will come back to. But the very important thing is that it is at the OECD level, validated by the G20, and therefore should be endorsed by all companies in the OECD scope, which goes, of course, much beyond the G20, including EMDE countries. So that, I think, forms a very strong base for any company that is interested to review its corporate governance framework on ESG matters. More specifically, what the OECD prescribes is the board should promote sustainability-related disclosure using internationally recognized standards and reliable metrics. The board should assess materiality if it can reasonably be expected to influence an investor's assessment of value. I'm citing, sorry. The investor's assessment of value, that's the financial materiality, as the American would say, but also the investment or voting decisions. When you get into investment and voting decisions, in particular on the voting side, you get much closer to the so-called double materiality, because what most investors now expect in the AGM votes and so on is ESG pay decisions, ESG strategy, and so on and so forth. And the OECD even states that the board may also consider matters relevant for workforce and other stakeholders, meaning that these principles of ESG governance should not be limited to the investors' point of view and the financial point of view, but also include the views of the workforce and the view of other stakeholders. So clearly embedding the double materiality EU framework. So that's, to my knowledge, it's the first time that a very respected international institution is really onboarding the double materiality in its considerations. Of course, one last point on the OECD, which is quite important as well, is that it recommends the use of safe harbors at the board level. And that, I think, is a very important point also, because it is one of the concerns of firms that are pushing back, as was mentioned, because clearly the risk of litigation is growing quite significantly, and I'll come back to that a bit later. What the OECD says is that board members should be protected against litigation if their decision has been made in good faith with proper due diligence. And that is a principle that doesn't apply only to ESG. It also applies to any other board responsibility, like, validating an M&A transactions or making any strategic decision in general. That is very important, and anchoring, if you like, the ESG governance into the broader principles of board functioning is both very demanding because it covers strategy, risk management, disclosure, remuneration, as I said, but it's also a protection, if you like, to have a pragmatic and protective approach to the board members, because otherwise the incentive to the boards will be to be extremely prudent in their objectives, in their stated objectives, which obviously, if they are less ambitious, we may not collectively reach the goals of the Paris Accord. So I wanted really to make a point on this OECD principle, and again recommend their reading for anyone who is interested. At EU level, I will not cover again this what Giovanni said already. On the ESG governance part, the CSRD is extremely specific, and the EFRAG templates, which, as you know, have translated the CSRD principles into specific disclosure items, requires on governance the description of the company's ESG governance, including the expertise of individual members of the governance bodies, the description of the ESG training and other educational activities, the ESG-related criteria taken into account in ESG board nomination. So that's actually quite intrusive, you would say. So it's part of the so-called fit and proper assessment of board members, and on and on. And there's a lot of specific requirements, including describe how ESG incentives are integrated in remuneration. Still, it is how they are integrated, which means a company can say they are not integrated, but it's really already a step in that direction. There's also a statement to be made on due diligence on the value chain. So that goes into the Scope 3, the capacity of companies to capture information on Scope 3 and engage with their suppliers and clients to increase their I would say awareness and progress on low carbon emissions. This will enter into force on the 1st January 2024, so it's not yet there. In two phases, one on the companies above 500 staff, and then in 1 year, the companies over 250 staff, which is a total of 50,000 companies across Europe. You can say it's a small number compared to the millions of companies, but it's already covering a large proportion of the GHG emissions. And so it will address a significant part of the current data gaps and data quality, because it also includes a third-party review and supervision by authorities, by market authorities in that case. So clearly things will be improving in terms of access to data and governance in the next 2 years in Europe. Then we have the CS3D, so the due diligence directive, which is currently still under discussion by the legislators, which moves from you have to disclose if you do it to an obligation to deliver, to do it. So it's an obligation to have a plan, a transition plan, ensuring that the business model and strategy are compatible with the transition to a sustainable economy and limiting the global warming to 1.5 degrees in line with the Paris Agreement, or lower than 2 degrees. So that's another very significant shift from disclosing what you do if you do it to do it, and that's very important. It also includes human rights and labor frameworks, sectorial regulations, including the value chain and so on and so forth. And in that case, it does prescribe the inclusion of ESG in the variable pay of the senior managers. So that will be another quantum leap, I would say, in Europe.
Sorry, I have to ask you to conclude. Sorry.
Yes. I will conclude on the outcomes and challenges. Where do we stand? In terms of finance, in the EU in 2022, 20% of bonds issues, 24% of syndicated loans, 20% of assets under management were ESG related. So it's a good start. Obviously, we need to accelerate, but it's already quite a significant part and probably driving prices in the market going forward. For banks, there is an additional layer of supervision by the ECB. And the ECB reports very clearly on this and says that 85% of banks now are including ESG factors in their governance. Not perfect, the ECB will never be happy and is pushing further, but it's already moving in the right direction. Broader at the global economy level, 90% of SBF 120, so the 120 largest listed companies in France, 90% include ESG risks in their board discussions. And close to 90% include some ESG factors in CEO variable pay. So the governance is really moving forward in France and in Europe. It's a real good news for Europe in general. Now, we need to. It's a huge transformation. So we need to move from that to a mainstream ESG throughout the organization. We need to have countries adopt global ISSB disclosure. And the good news is that close to 400 organizations have expressed their support to ISSB during COP28. This is really good news. The OECD principles should be adopted now that they have been endorsed by the G20. That's very clear. Mm-hmm. So we need harmonized standards, but there are areas, and I will finish on this, where we need more standards at global level. We need standards in terms of methodologies to measure Scope 3. This remains an area where there is too much confusion in various methods out there. We need standards as relates to sustainability audit. There are some recommendations by the auditing standard board, but it still needs to be finalized and endorsed. And ESG rating methodologies, as Giovanni was saying, definitely the supervision of ESG rating methodology will be key. In Europe, it will be ESMA. In other countries, we don't know yet. We need also standards on transition planning, which is a vital input to ESG assessment by financial firms. And of course, we can't stay at the level of climate, and we need the rest of environment. So the ISSB needs to expand to nature and social issues as well. So okay. I will stop there. Thank you very much.
Thank you so much for sharing these recommendations and the good news about the advancements happening in Europe. And it was a very nice overview of the corporate governance and all the efforts have been done to enhance ESG implementation from the boards of the companies. So that was very informative. Thank you so much, Véronique, for this overview. We are lagging a bit in time, so I move directly to our next speaker, Mr. Alex Struc. You are the founder and CEO of GOALSFIRST, and I would like to hear your insight about challenges regarding implementation of ESG-related KPIs from a financial sector perspective.
Yeganeh, thanks for introducing me and for the time as well. See if I can maybe be 10 minutes and finish quicker than there are a few messages that I have to deliver and reclaim our time back. So let me share my screen first and foremost. I think you've asked me to, let me just do that. Can you see my screen?
Yes, it's coming up. Not yet, but yes.
Is it now up?
Yes.
Okay, it's perfect. Okay, so if we, let me just do that. If we concentrate on the metrics and targets, as you've asked me to do, and potentially with difficulties with their implementation, let me just bring them up. Metrics and targets, fourth pillar of TCFD reporting, and just for illustration purposes, you have principal adverse indicators before they've been updated from M1 to M14. There's quite an extensive list. If you're a financial company, which we are, we're a privately owned alternative asset management firm focusing on liquid and scalable investments. There are two ways in which you can continue that conversation. One way is to say how difficult it is to find all these details, call for standardization, or potentially call for action to regulators. We tend to go the other direction because in our strategies, we target risk-adjusted returns, superior risk-adjusted returns, and outcomes related to sustainable development goals by all means possible. So in our framework, what we tend to focus on is a few of my fellow panelists have already mentioned. If we just apply the lens of TCFD, what's missing is the governance standpoint, the strategy standpoint, and the risk management. So from managing portfolio perspective, if you look at the integrity of every single metric, metric only comes down as a fourth step in the equation, because first is the governance largely answers one question under TCFD, which is who is in charge. both from a board perspective and from management perspective. And the beauty of using TCFD framework, that if you delete the word climate out of TCFD, this is an organizational framework that is useful for any management at any time for any issues, which is primary question, who's in charge, a delegation of duties on carbon, on GHG intensity, on a number of other things. Number two, what it is that a company wants to do from perspective of a time horizon, what are the sensitivities, and more specifically, sensitivities and resilience with respect to business strategy and financial planning. So there's a very concrete questions that one is to understand from if you just look at the metrics. And the last piece is risk management. And I know we have few risk managers on the line if I look at the participants. Basically, the simple question is how much will it cost? And more specifically, how much will a mistake cost and how we can mitigate it? From a management perspective, identification of risks and integration. Only after you completed those 3 steps, then comes out metrics and targets. Metrics and targets in isolation are completely unuseful. And if you're looking at today, Bloomberg came out with transition report talking about biodiversity. According to that, 31% of companies have a biodiversity strategy, have a biodiversity policy. 9% have biodiversity strategy, and 2% actually monitor the impact of their activity on biodiversity. So you need to look at governance. So from this perspective, and the TCFD framework in general, I think is a good rule of thumb. So from this perspective, the next slide, I'd like to take it back, and there's plenty of education of differences of ESG investing versus impact investing. We tend to look at the universe in from a finance standpoint at a very different manner. If I put on an x-axis liquidity in scale, which is just simply size of the market from low to 110, 120 trillion managed to globally, professionally. And on a y-axis, you put clarity of outcomes. Every time you as an investor invest, you get understanding of what the company is doing. And on the lower end of that, you have general corporate purposes like sovereign bonds and corporate bonds. On a higher end, you get project finance. So if you look at this, and if you look at the entire financial universe in that space, the majority of assets sit in this lower right quadrant, which is high liquidity and scale, low quality of outcomes, because everything is for general corporate purposes. Sovereign debt, listed equities, corporate debt, semi-governments, supranationals, majority of AUM. If I look at the top left, and if we forget about the denomination of impact, if we just for a moment, these are specialized offerings. This is where investors invest, but they know exactly what the money is doing. Project finance, leverage loans, private equity, venture capital. So this is highly use of proceeds bonds. Mind you, we haven't even come to sustainability outcomes just yet. So from here, you can use the entire space to move in 2 directions. So far, disappointingly, financial community have chosen to adopt the posture that investors want ESG, and they start creating funds in this lower quadrant, which is lower liquidity and scale than traditional assets, and just as ambiguous in terms of outcomes. So as a result, you have very divisive positioning, lower liquidity and scale, terminology sensitivities, and the companies that create funds in this space, understandably so, because there was quite a bit of hype on ESG, is asset retention at best. What we're seeing, not only from our perspective of how we develop our own company, but the biggest and credible flows, both where you have can nurture the relationship between the companies, asset managers, and the investors, is this space, which is risk, return, and impact space, which we call outcomes-orientated investments. And there's 3 features where we create, or we can create funds that gain most momentum. This space, we're not the first one in this space. You can see a number of players are moving from left-hand side, from the specialized offering, private equity, into the space. Some of them are moving from a lower right-hand side, like municipal bond, into the space. But they primarily, the idea is very simple, which is you blend scale and clarity. So scale of large liquid assets with clarity of outcomes related to project finance. And regulation is helpful here, but it's not all the answer. Number 2 is focus on goals. And by that, I don't just mean sustainable development goals. I mean, broader trend than that is move away from strategic asset allocations to total portfolio approach, where wealth management clients, retail clients, pension funds care about general outcome that they're getting with their investments, and hence focus on goals. Here, obviously, sustainable development goals have been super, super helpful in getting that, in targeting in combination with scale and clarity. And the last piece is the most interesting to us, is investor vote. Ability to pass through an investor vote to any investor embedded in this, embedded with funds, basically increasing the agency for individual capital providers, be it retail, wealth management, sophisticated or not. So we mostly get questions, a lot of questions about investor votes and specifically influence, because it is a misnomer that influence only pertains to equity investors. So let me bring up one more chart as to how we debunk all of this. If you look at 0, low, 10, high in its intensity or size, and a variety of asset classes, everything from multinationals to project finance, investment grade bonds, private equity. And we look across 3 main pillars. Number 1, clarity on uses of proceeds. Sovereign debt, general corporate purpose is obviously very low. Venture capital, project finance is obviously very high. Second is scalability of finances, which simply is the size of the market. This is easy to quantify. And the third one is most interesting to us is engagement leverage, which is, as a capital provider, where do you have the most additional powers to influence the companies of management? And incidentally, we don't think it's equity. The highest powers that you have as an investor is in private equity, venture capital, shareholder loans, investor-grade loans, securitized assets, and project finance. The lowest ones, where you, as an investor, you don't have a say, you just have to get the deal that is given to you, is sovereign debt agencies, multinationals, anything that has a very strong regulatory component. High yield and leverage loans are in between, depending whether you defaulted as an investor or not. You get more say or less say. Equities are in the middle for us because of the difficulties with filing resolutions, both in Europe and the United States, and your ability to win. And most underestimated is ability of bond investors to influence an outcome. So if you look at the combination, what you see in front of you is so-called betas around clarity on uses of proceeds, scalability of finances, and engagement leverage. And it's an important consideration when we look at creating products to not have one fit-all approach to all capital. Embeddedly, every piece of financial borrowing, every piece of financing has its embedded properties about how much do you know about the company, about the size you can deploy, and about the influence you can exert as an investor. So with that, I'll conclude with the biggest opportunities we see for asset management, and from highest to lowest. Number 1 is engagement alpha. Engagement alpha is driven by the property right, which is every investor is own its ability to influence an outcome and its most asymmetric outcomes that one can exert. Mind you, 80% of investors in UK and the United States either don't know or do not actively execute their voting rights. We think engagement alpha, or we actually, quite frankly, bet our financial well-being on the fact that engagement alpha will be a mandatory component of investment offering. It should be a mandatory component of investment offering, specifically because it's owed as a property right. Number 2, it outcomes orientation. And we're not only seeing with millennials, we're seeing across wealth management transfer, we see defined benefit moving to defined contribution. Simple ideas behind that. Number 1, universal ownership. Investors understand that by owning a dollar, they now own not only part of society, nearby society, they own part of the world. So it's taking a universal ownership approach. And number 2 is dynamic asset allocation, ability to change your mind frequently. Number 3 is asset management in itself. Asset management is going to grow by 30% assets under management in the next 4 years. And mind you, professionally managed assets globally is only 40% of the global wealth. 40% penetration rate of total wealth is professionally managed. So it's a significant opportunity. There is a scant competition in outcomes-oriented space, and it's extremely capital efficient business. Yet, and it's, I think for the first time in many, many years, where new enterprises can actually compete for the slice of the pie with established managers. And to complete this, that would be innovation. And I'm obviously on time. And innovation is the most significant conclusion here is that if before, whether you're successful or not as a financier, depending on your level of access, can you find a broker? Can you find financing? Can you find counterparties? Today, this is more accessible, and the quality of insight, ability to understand subject deeply and provide a knowledge is it beats the level of access. We've distributed model, of course, brought in by COVID and technology. Today, to set up an international company, you don't need to be in one city or the other city. You can pretty much do it instantaneously and access multitude of markets. So it's very exciting. I think you asked me to speak of metrics, and I say metric is today, focus of a regulation is understood, but it's not decision. The way that metrics are presented today are not decision useful without understanding how they've been governed, what's the strategy underlying them, and what's the risk management techniques. So from our perspective, we spend most of our time on reading sustainability report, financial reports, stewardship reports, which have been extremely, extremely useful to glimpse an idea of how folks are arriving on those metrics, or whether those metrics are dormant or actively managed for. And with that, I thank you for your time.
Thank you very much, Alex, for this holistic approach. I mean, this was very interesting to know about your approach, and I really love the idea of the engagement alpha in this framework, that people who are, because of the property rights, and people should know what they are investing in. And so since the time is running, we go directly to our next distinguished speaker, Kwame Sprang Barnieh. You're a partner at KPMG Ghana. So I wanted to ask you about the hurdles and different success stories of ESG implementation in the African countries. Thank you so much for your time. The screen is yours.
Yes, thank you. Thank you so much. So yes, great discussion so far. I mean, at KPMG, we have an impact plan where we make sure that as a company, we go through this same process of making an impact. I'm just going to talk to you through some of the hurdles, but before that, I want us to watch a quick video, and then please confirm
the world
if
has
you
changed, not just COVID.
Yes, but you need to increase the sound, I think.
Of the world and the businesses they buy from and work for. Your shareholders and lenders are under pressure from regulators and the market to prove that they're acting responsibly and investing sustainably. All will be making choices about which organisations they work with. So will yours be one of them? Each stakeholder looks at your business through their own lens, and this is your opportunity to choose what's behind it. What is your impact on our planet? What do you contribute to the communities you operate in? And how do you conduct yourself? ESG isn't something you do, it's everything you do and how you do it. It's your license to operate, and it's your opportunity to lead. Your ESG strategy must be authentic, embedded in your business strategy, and owned by your board. Your ESG narrative looks right across your business and tells that story to the world. And your ESG metrics help people compare you with others, often via a rating. You'll want to consider how you conduct yourself as an organisation and look to the ethics throughout your supply chain. What part do you play in the community? Is your business inclusive? Are you well governed? And is your leadership diverse and set up to hold the business to account? Look at the impacts of climate change, the natural resources you consume, and the waste you produce. Do you pay fair taxes? Treat your customers and suppliers ethically? And do your employees have safe, fair working conditions? And could they speak out if they see something wrong? Understand where you're strong and can be proud. And know where you're vulnerable, and then have a plan to make it better. People will expect you to set clear targets and have the data to measure your progress and report it to the world. They'll want the assurance that what's behind the curtain supports your performance and won't let you down. Your metrics will encourage investment, and your narrative will talk to your stakeholders. When you're done, you'll have a resilient business set to thrive in the new reality. And you'll be playing your part to make the world a more sustainable, fairer, and better place for everyone. It's the right thing to do.
So I think it's very clear that, I mean, ESG, and even from all the speakers that have come before me, I think one thing is that they've made the case that ESG is here to stay and is the right thing to do as an entity. However, navigating that whole process of ESG is not something that, I mean, has come to us simply. So, I mean, I'm just going to go through some of the kind of challenges that we have. I mean, With regards to the lessons that we've learned, I think increased default risk is something that is very clear for a business term. And again, I just talked through a quick example. If you look at ASX, we reported annual average loss of about 6.2 million euros due to windstorms in real estate. And this is a clear challenge from an environmental issues that emanating. If you look at the reputational issues, most of us can relate to the BP oil spill. That as a company, if you are in the news for some of these significant, things that are constantly in the news, CNN, Fox News, that's not where you want to be as an entity, right? Remember Volkswagen putting in some sort of illegal or defective device to kind of cheat on the emissions, that are reported in Europe. But one important area that I think we can note has to do with operational disruptions, right? Or even loss of lives. Here in Ghana, that there was a huge explosion in a filling station that caused about 150 people to lose their lives. And I think we can talk about a lot of these like life losses that we cannot pay back. Supply chain disruptions, which impacted everybody. The Suez Canal, was blocked for God knows how long, and the impact on us were huge. So I think there's a reason why ESG is taking shape from loss of lives, loss of money, and just impacting us as organizations and individuals. So I think that case has already been made. So I'm not going to belabor that. What are some of the success stories? Very, very clear. I think UPS, we all know UPS. They installed an AI-driven route optimization, which again, the results are clear, right? They've saved loads of fuel annually, but more importantly, what has been measured is that the carbon footprint that is saved annually is about 100 metric tons each year. This is powerful. So for one company, taking the decision to take a step to become more responsible is becoming this impactful. You look at Tata. Tata put up just installing solar panels across about 90 cities in India. And the impact is fantastic for all of us. You look at H&M. What do? They began collecting and categorizing discarded clothes. Restoring the wearable ones, recycling through, and the impact is clear. In 2019, what has been reported that about 57% of H&M's raw materials were used sustainably. And as a company, you score big, not just on the impact, but also on the reputational side of it. The point here is that ESG can be embedded in your strategies, in your business strategies, and it can make business sense, and it will make business sense to you as an entity, right? So these are all examples that I think makes it clear that through your own value chain, you can make some big decisions. And that's why in the video, and even some of the presentations earlier, the case has been made that the board must own it. It must come from the very top. It must be embedded in your strategy. It must make sense. It shouldn't just be a side activity where you're just doing it as part of something small, or just reporting something to a small group. It must really be inculcated into your business, right? Now, this is where it gets interesting with regards to some of the challenges in implementing it. I think most companies, if you speak to the key decision makers, they want to do this, right? But what has been some of the main challenges? And I think some of these points have already been alluded to earlier, but just to kind of quickly touch on a few of them. There's been multiple frameworks on ESG trying to make us organized and structured and try to standardize. But I think thankfully, we all know IFRS S1, S2 that has been published is really going to drive a lot of standardization for us, right? So these multiple frameworks, I think a lot of people spoke about now Europe moving to the reporting standard from GRI and all that. I mean, there's been a lot that's going on, but I think IFRS S1, S2 is going to save us on that. What data should you collect, and how should you manage that data as part of your value chain? I think the complex data management process has also been a challenge for a lot of entities, because getting data and getting good data to analyze is a huge part of intentionality and strategy that we need to embed on. Understanding and managing and quantifying ESG. I mean, risk management itself, as has been alluded to earlier, is something that has to come as a part of how you run your business. Now, how do you know how much you're making as an impact for your business and for society, right? Quantifying this whole process of ESG has sometimes become a bit of a challenge. And then there's a lot of evolution in this whole discussion. There's a lot that's evolving around regulations. I mean, what are regulators in specific regulated industries? I mean, what do they want to look at? Why do they want to look at this? This also keeps evolving, and I think it's challenging entities. I mean, what can we do? I mean, to make this a bit simpler? I think, in summary, the first point is that ESG is important and is good for business. If you're a business that really want to be around for a long time, you want to have the right stakeholders, you need to adopt ESG principles and inculcate it as part of your process. That's number one. Number two, you need to be very clear with regards to your strategy and your policies that you are embedding on ESG and how that becomes part of your core business. People that you work with, people that make decisions, must be trained on how this is going to be done. The culture of making an impact must become important to you, and people must understand that these must be tied to their performance evaluation processes, so that it becomes part of what you do. Board level oversight, I cannot overemphasize, I think it's been said earlier. The board must be the biggest promoters of the ESG strategy, and they must have ways to oversee how much progress we are making as an entity. I think continuous improvement, there has to be a way to really measure how well we're doing as a business and what practical results we are getting. That need to continuously become better in making an impact is a key. And then I think I spoke about the last one, which is integrating into your strategy. You cannot make ESG a checkbox exercise or something that's stuck somewhere. If you analyze your value chain properly, you can understand opportunities for making an impact, right? So in a nutshell, I think my presentation is really making the case for ESG is here to stay. ESG is important. There are some challenges, but if we take a step back and look at how we let the board own it, how we make it part of our strategy, how we train people, how we are intentional about policies and procedures, ESG will definitely make the right impact for us. So thank you very much for your time, and then back to you.
Thank you very much, Kwame, for sticking to the time, and also for these very key messages and clear messages of the importance of the ESG's implementation, the success stories, and also the hurdles and challenges and how to face them. So without further ado, I would like to invite our next speaker, our final speaker in this panel. Mr. Andrea Abbate, you are an ESG and impact specialist at Banca Etica, and I want to hear more about your experience in dealing with ESG issues as an actor in a commercial bank. How does it work? Thank you so much for sharing your insight. The screen is yours.
Okay, thank you very much. So thank you for having invited Banca Etica to this event. So do you see my screen?
Yes, it's coming. Yes, that'll be. Yes.
Okay, perfect. So I'll try to be very quick since we are in delay. So just a few words about who we are. We were founded in 1999. We are a cooperative bank. We operate in Italy and Spain, where we are called Banca Etica. We are owned by a movement of citizens and social organizations, and we are inspired by the principles of ethical finance, which are transparency, participation, sobriety, efficiency. And as you can see, we have ESG aspects in our principles because the awareness of the non-economic consequences of economic actions are ESG actions. And we believe that credit is a human right. And I wanted to start with a little focus on our credit regulation before talking about ESG assessment. You can see we have exclusion criteria. We have different areas of exclusion, and I have highlighted the environmental one since we are during the COP28. You can see we will never finance activities which have negative impacts on the environment, and activities that use and develop the technologies that pose at risk to humans and environment, and the intensive animal husbandry. So the social environmental assessment process of the bank, for every financing to legal persons, we do a double investigation. We do the normal investigation, which is the economic and financial one, but we also do a social environmental assessment, ESG one, which is focused on CSR, so the ESG internal aspects of the organization, and about the impact, so ESG external aspects. How we do it? We do a social environmental questionnaire, and all these activities remain inside the perimeter defined by the exclusion and privileged areas. The assessment is carried out by social assessors, which are members and volunteers who visit the client during the assessment phase. So we have a multi-stakeholder approach. And since 2020, we publish our impact report, which accounts for 100% of the bank's assets in terms of impact. So why we do a ESG assessment? We do first of all for management purposes, because we need to have an internal control on ESG aspects, because we want to be sure that our customers have a high responsibility profile and that the credit generates a positive impact on the environment and on the social aspects. Then we have statistical purposes. First of all, accountability. As everyone said, we need to report, communicate how the savings collected by the bank are used and what kind of change they generate. And then we are trying to develop a probability of default and ESG rating models based on the social environmental structural characteristics of our clients. And then last but not least, cultural purposes, which is very important for an ethical bank, because we are trying to disseminate a culture of transparency, relevance of disclosure, and importance of CSR themes. What we measure CSR aspects with 150 indicators that are divided in 7 areas of value. You can read them. And then we try to measure the impact of the finances, which is a direct impact for the bank, and the impact of the organization, which is an indirect impact from the bank perspective. We have 24 impact areas and 40 indicators. So what we label impact? This is really important to be transparent about this. About business loans, the impact is assessed with ESG questionnaire. If you have an impact, then we will label as an impact finance. About personal loans, we have impact designed products, for example, green housing, and we also look at the customer profile. For example, if you are a woman, a youth, unemployed, immigrants, and etc., it will be a personal loan with an impact. And then about securities portfolio, for our perspective, impact is inside the social bonds and green bonds, and with microfinance and ethical finance institutions. So a few words about ESG rating. Why we do a ESG rating? There are purposes of internal use, for example, classification of the customers, for the investigation that I said before, for analyzing the trends during the time of the CSR profiles of the organizations that we finance. It's a communication tool inside our impact report because it's very synthetic, and we can use it inside our supply tenders. It's included in the default probability calculation and inside the pricing models of the bank, and is also a representation tool of the ESG risks. Then we also have a client use. For example, the customers can see their positioning in the relation to other finances entities. So they can also have some benchmarks within the ESG aspects of the rating. And it can be a useful tool for change, because if I see my competitors are much better than me on, for example, environmental aspects, I'll try to be better on those aspects, so it will be a tool for change. But it can also be a communication tool, because it can be included inside, for example, sustainability reports. It will never be a criteria for deciding the financeability, because in our view, a rating will never be sufficient in deciding if a client can be financed by Banca Etica. How is composed this rating? You can see we have the 3 areas, and each area have specific indicators that try to explain how good you are in every ESG aspect. You can have the slides, so you can read them after. And some few words about how we try to manage our impact. So when I talk about impact, I talk also about ESG. We have this impact appetite framework, which is a tool for the board for continuous monitoring the impact of the bank, in order that we can introduce corrective measures. You can see the YAF complements the risk appetite framework, and we have some thresholds. For example, appetite threshold, which is the target that the board intends to achieve on each indicator. We have a early warning threshold and a tolerance one, which is the minimum level of the figure where there is a serious risk of non-achievement of the bank mission. You can see here all the indicators inside the impact appetite framework. We have 5 areas, which are environment, rights, which is a social area. We have governance, we have international and peace and justice, and the promotion of ethical finance. Every area has some indicators, and all the indicators are 27. You can read them, but we have inside indicators, for example, the single website visitors, but we also have outside indicators, for example, the loans that we provide for combating climate change. Then I will close, since we are during the COP28, about the decarbonization strategy of the bank. A few words about the bank's carbon footprint. In 2019, we were signatory of the climate change commitment of the GBV, which is the Global Alliance for Banking on Values, where we committed to monitor the emissions of our investments by 2022. But we did it in the next year, the near next one. And following the PICAF methodology, we were the first Italian bank to disclose the Scope 3 emissions. Nowadays, our direct emissions, so Scope 1 and Scope 2, have decreased by almost 70% since 2018. And with regards to indirect emissions, so the emissions deriving from loans and investments, we are progressing towards the decarbonization plan in accordance with the SBTi, and we are able to disclose in terms of emissions the 91% of our total assets. And we are also committing to sign the fossil fuel non-proliferation treaty. And few words about our strategy. Since we do not invest in fossil fuels, we cannot disinvest, but we can involve our clients, which are mainly SMEs, in our decarbonization strategy. So our clients and members have a discounted asset to carbon footprint calculation tool, so we can have data about carbon footprint of our clients. Then they have tools in order to plan the reduction of their emissions, so a decarbonization plan. And then for those who sign up for a decarbonization plan, we have environmental covenants. So as long as the organization is in line with its emission reduction plan, the bank will apply a discount to their interest rate. So this is our experience, very quickly on ESG aspects. So thank you very much for the attention.
Thank you very much, Andrea, for this nice concrete example of how ESG assessment is implemented. And also it was impressive the number of indicators you implement. I have a lot of questions right now, like how costly it is to have these reports and assess all those indicators and so on. But unfortunately, we are running out of time. I invite everybody to open your the speakers to open up their cameras so we can.
Sorry, Yeganeh. Sorry.
Yes.
Can you hear us?
Yes, please.
Yeah, okay, we can have 15 minutes for discussion if you want.
Yeah, so but if you can stay, that would be amazing. So please turn on your cameras, and then we move on with the discussion. So I have
let Yeganeh, thank you very much for the moderation. Thank you all for being with us today. We got 10 minutes more over here from the organizers around here, so we can discuss a little bit the importance of ESG. And I was in another meeting on just transition and the role of small and medium-sized enterprises to be, I would say, the game changer for changers for the green, circular, and low carbon economy. So the whole idea, and we know this, it's about data collection on how companies are really contributing to this transition. Of course, companies, they go to banks or they go to financial institutions, and they need to show this data for the banks to collect the indicators on ESG. So sometimes there is a gap between what the SMEs have and what the banks would require. And I would like to understand how we could reduce this gap. And this question is addressed to Véronique on one hand, and also to Kwame on the other hand, and also to Andrea, because since you are a bank, but of course your bank, it has already in your principles to lend to, I would say, ESG type of clients. So I would like to see really how in practice you do it. So this is my first question. My second question, there has been an article in the Financial Times, and there is a kind of a backlash on ESG type of investment, particularly in the US. There has been a reduction of ESG compliant bonds from 4 trillion to 3 trillion in less than 2 years. Is this really evidence that the market for ESG type compliant bonds is getting smaller, means that because of the interaction of ESG and the three, I would say, concepts are so broad, so it confuses a little bit the investors, and then it might lead to a reduction in this, the involvement of the investment funds in the market. And this question is for Alex. Véronique, if you can say something about the gap, and then
Yeah, thank you very much, Rim, for the question. It's obviously a very crucial one, because even in Europe, with the CSRD coming into force, it only covers, as I said in my presentation, 50,000 companies, which is a big number in terms of global emissions, but still a small number compared to the number of companies operating in the EU. And for long, the SMEs have been thinking that they would be basically exempted, I would say, by all these reporting requirements, but actually they are caught into the same challenge, I would say, for two reasons. One is, of course, the banks, as you said, but also because they are part of value chains for larger companies, many of them. And therefore, they not only the banks are asking them, but also the larger companies, if they want to get their projects and then products bought by bigger companies that are in the scope, they will require also information, because the scope 1 and 2 of that company is the scope 3 of that bigger company or of that bank or investor. So they are, I think, waking up to that concern, maybe late in the process, but they are definitely moving in that direction. At the same time, the European Commission has mandated EFRAG to provide simplified templates for SMEs, which is consistent with the general principle of proportionality because in practice, SMEs have a reduced product range compared to larger groups, and therefore they will probably have like 1 or 2 or 3 levels of decarbonation, if you like, and you have to do a very specific industry analysis of that company and identify the 2 or 3 aspects that are really significant, and that's where this materiality assessment. And I'm not talking about single or double materiality, but just the fact of whether this information, this KPI is relevant or not, is so important and has been introduced, thankfully, by the European Commission context. But clearly, it's still a challenge going forward.
Thank you, Véronique. Kwame, do you have anything to add?
Sure. So yes, I think the point made earlier by myself that ESG is relevant, and that's why banks are encouraging it and making it part of their credit risk management processes and their overall risk management process. So how do you reduce the gap? I think organizations or bank customers who are playing or relating with banks need to see ESG as part of what they do, and therefore really understand the reasons why banks are getting the data, right? So once you know it's important, that's one step. The second step is operationally, as part of your process as a business, you need to collect this data. You need to have it in a form that can be verifiable, a form that can get the bank to easily analyze it. Because if you know it will be taken from you and you prepare it earlier and it's in the right state, the questions go down, the whole gap. So I think ESG cannot be seen by an entity that's playing in the world or in the financial sector or in any other sector as an afterthought or as something that is beside. It has to be really thought through your strategy. The data governance must be right, and you really need to understand what banks expect and even why they're taking this from you so that it doesn't become as a surprise for you. Thank you.
Thank you, Kwame. Andrea, do you have anything to add from your perspective, since you have Banca Etica and of course your bank is focused on these matters?
Yeah, what I will add about is that, okay, from our experience, what we did is that we tried to design a very simple path in order that also SMEs that are not conscious about their ESG aspects can fill in all the data, but we tried also to give them support, not only with social assessors, but also with our partner. But what I want to add is that we must not hope that companies will give data because they have to be compliant with regulations, because the worst thing that can happen with regulations is that they pay a fine. So what we have to do is trying to spread the culture of transparency, the culture of ESG, and from our side, from the bank side, is that we have to give them incentives to collect ESG data. For example, the organizations are giving us all those data. What we are trying to do is give them automated report. So you disclose ESG aspects. What we give you is a sustainability report automated based on ESG data. So this is a real good incentive to be transparent and the best disclosing.
Thank you, Andrea. Giovanni, how do you see this from the research point of view? I know that we have talked about this specific matter before. What do you think?
There is a big risk because the process is top-down only, in the sense that it comes from financial regulation and it comes through the productive chains. But the SMEs are not, they don't have their say. They don't probably, so they might try to minimize their effort, which means using faulty certifications, and that might produce a third-best situation in which the ESG approach might be seriously damaged. So if you wish, my view is that we should try to provide some public agency support to the SMEs in terms of helping them certify their real ESG situation. Otherwise, they will be at the mercy of financial regulation, and banks are Banca Etica is an exception. Banks are not going to help the SMEs in that respect that much, or they are going to be at the mercy of the leader of the production chain, which will just cut them off.
Yeah, that's very clear. Giovanni, Alex, what about the point I raised on the potential reduction of the market of ESG compliant bonds based on this backlash that we've seen, particularly in the US?
Yeah, so the short answer in one sentence, and I'll elaborate, I don't think it will reduce. I think it's temporarily. I think over long term, you're looking at a structural trend, and what you're looking at right now is just a tactical headwind. And the reason for that is very simple. I think it's generally unhelpful to split, we find, investors into ESG investors and non-ESG investors. Underneath, what people are looking to do, what investors are looking to do, is linking financial decision with social architecture at scale. So the demand for outcomes orientation, understanding what your money is doing, is way beyond denominations of ESG or non-ESG. So the size of the market is a key distinction. It's not about ESG being 1% of the world and 99% doing something else. What we find interesting is pitching and providing solution to 99% of the world with a more enhanced investment product that looks at the outcomes. So that's a starting point. It needs to be financially viable. The second is about it's all conversation about a use of proceeds versus general corporate purposes. And structurally, in general corporate purposes, people or companies who would, institutions that would issue, as you call it, is ESG compliant or outcomes orientated bonds, there's a lot of pent up capacity for multinationals, supranationals. I'm talking about EIB, KfW, IBRD, to issue more, municipals to issue more, supranationals to issue more, regions of individual countries. I'm talking about Canadian provinces, and quasi-governments, I think they called in Australia. So regions that is private capital for public purpose. There's a lot more pent-up capacity to increase that. And the last thing I'll mention is investors investing in stuff like that should really, I think, dial down the greenwashing rhetoric. And the reason for that is very simple. We must also remember that companies that issue green debt, for example, taking the burden of additional reporting, additional governance, and additional scrutiny. And it's done at their own cost. They're issuing debt at the same level sometimes that they can issue otherwise in the market. So we're not dealing with situations where companies are coming to the market and trying to arbitrage the market for additional financing actually it's significant issuers who can have access to finances anyway and coming to the market to increase their visibility with investors, increase the following, and it's done at their own cost. So to answer your question, going back to the original statement, I think the fluctuations in demand that you're seeing right now is only temporary. Overall, I think the labeled market, which basically increases clarity, should be 3 to 4 times higher in the next 5 years.
Thank you, Alex. This is, well, that's what we hope, to have this market really accelerated to ensure that the green transition is happening, and we need it. I mean, that's very clear. So with this, I think we are now at the end of the panel discussion. I would like to thank Véronique, Giovanni, Alex, Kwame, and Andrea, and also Yeganeh for moderating this session. We are here in Dubai. Tomorrow we are, or after tomorrow actually, we are all back to Europe. Thank you very much for your discussion. And I think we need to have a picture for communication for the office. Just stay online just a little bit until we have this picture. And then
we did it here.
Yes. Yeah, we have to go there.
Yeah. It's not better to open up.
So we can help everybody. Hello.
Hi, George.
In this case, we have to improvise. Thank you so much.
Thank you.
Okay, thank you all.
Thank you very much.
Thank you.
Thank you.
See you next time. Thank you for the contribution. Bye-bye.